Okay, so Bitcoin just took a massive nosedive. And the question that everyone is asking is this it? Is the bull run officially over? Or was this just a necessary shakeout, a purge before the next big leg up? To really figure that out, we have to look deeper than just the price. We need to see what's happening behind the curtain.
Yeah, this is the question that's probably keeping you up at night, right? I mean, after the incredible run we've had, a sharp drop like this, well, it puts everyone on edge. So are we staring down a new crypto winter? Or is this just a really, really dramatic, but maybe ultimately healthy correction?
And look at this, the fear and greed index is sitting at a 10. That's extreme fear. I mean, it is hard to get more fearful than this, but here's the thing you have to remember. Historically, when fear gets this high, it's often a screaming signal that we're near a major bottom. It's a classic contrarian indicator. When everyone else is panicking, that's often the time to pay attention.
All right, so to figure out what's really happening here, we need to put on our detective hats for a minute, because we've got a real mystery on our hands. The first big clue is kind of weird. Why did Bitcoin just fall off a cliff while its usual partners in crime, the other assets it normally moves with, just didn't?
So check this out. For ages, Bitcoin and the tech-heavy Nasdaq have been like dance partners. When tech stocks go up, Bitcoin usually follows right along. But look what happens starting October 1st. That connection? Gone. Poof. They've totally decoupled. So whatever's going on, it's not the Nasdaq's fault. That's not our culprit. And the plot thickens. It's the exact same story with gold. Bitcoin is often seen as digital gold, so they tend to move together. But just like with the Nasdaq, that relationship also just disappeared right around the beginning of October. This tells us something else, something bigger is pulling the strings here. So, if it's not tech stocks and it's not gold, what is it? Well, this brings us to our prime suspect. There's another force out there, one that has an even stronger grip on Bitcoin's price, and that force is market liquidity. Basically, it's just the amount of cash that's sloshing around in the financial system, ready to buy stuff. Okay, so if liquidity is the key, then the next question is obvious. What's been happening to it? Well, spoiler alert, it's been disappearing. Someone's been pulling money out of the market. Let's follow the trail. Okay, look at this. This is the U.S. Treasury's bank account at the Fed. Back in mid-July, it had about $300 billion. Fast forward to October 1st, it's jumped to $800 billion. And today, it's sitting at nearly $1 trillion. Do the math. That's more than $650 billion that got sucked out of the financial system and just parked on the sidelines. So why is that such a big deal? Well, it's simple. Less liquidity means less cash for people to buy assets like Bitcoin. Think of it like fuel for a rocket ship. When you start draining the fuel tank, the rocket's not going anywhere. The engine just sputters. There's just not enough buying power to keep pushing prices higher. And that, right there, brings us to our conclusion. This huge liquidity crunch, this massive drain of cash from the system, that's the direct cause of Bitcoin's sharp reversal from its October 6 peak. The big players, the smart money, they saw the fuel gauge hitting empty and they knew it was time to sell. But wait, the story doesn't end there. Just when things were looking grim, with all this money being sucked out, we got a new and pretty powerful signal from the Federal Reserve itself. So the huge question now is, are they about to turn the money taps back on? Now, this is where it gets really fascinating. The president of the New York Fed basically sat down with the big banks and said, hey guys, what are you doing? You're borrowing money from each other at these high rates when you could be coming to me. I've got it cheaper. I mean, you can't get a clearer message than that. He was practically inviting them to come tap the Fed for cash. So how does this actually work? It's a thing called the standing repo facility, and it's actually pretty straightforward. A big bank needs some quick cash. They hand over a Treasury bill to the Fed, kind of like collateral. In return, the Fed lends them cash overnight. And the most important part? Boom. Just like that, brand new liquidity gets injected right back into the financial system. Now, let's be clear. This isn't that full-blown quantitative easing, or QE, that we've seen before. These are just temporary loans. But, and this is the crucial part, they still have the exact same immediate effect. They expand the Fed's balance sheet, and you guessed it, they boost market liquidity. In other words, they're putting fuel back into the system. Okay, so let's tie this all together. We had a liquidity drain that crashed the price. Now we have a signal that the Fed might be turning the liquidity back on. With that in mind, let's look at the price again. Was that crash the beginning of a long bear market? Or was it just a really painful but maybe necessary correction?
All the evidence is really pointing to this being a purge. You had less cash in the system and prices were super high. It was the perfect setup for the smart money to trigger a sell-off and just wipe out all the traders who were using too much leverage. This looks a lot less like a new crypto winter and a lot more like a healthy correction inside a much bigger uptrend.
And the charts seem to back this up. There's this technical framework called Elliott Wave theory, and the basic idea is that markets move in patterns. And corrective phases, like the one we're in, often have a beautiful symmetry to them. So that first drop, wave A, was about $23,000. If this current drop, wave C, is roughly the same size, well, that gives us a pretty clear target for where this might end. And what's really remarkable is that this symmetrical wave projection points to a target right around $93,000. But get this, another completely separate technical tool, the classic 0.618 Fibonacci retracement, also points to that exact same zone. Look, whenever you have two powerful and totally separate methods of analysis pointing to the exact same price level, that's a signal you can't ignore. It strongly suggests that this $93,000 area could be a massive floor for the price, a potential bottom for this entire correction.
So, let's put it all together. We have a market gripped by extreme fear, which is often a buy signal. We have a potential reversal in the liquidity drain that caused the drop in the first place. And we have technical charts pointing to a strong support zone right where we're sitting. This leaves us with one final powerful question. Are we looking at a market on the verge of panic? Or is this the buying opportunity of a lifetime?